Hello, boys.
Hello, Claudine.
Hello.
We're joined today by attorney Robert Hansen. Thank you so much.
Sure.
We had done a video and article about Australian superannuation funds, the confusion that it just sort of floats around them. Nobody really knows how to treat them. After doing that video and that article, we got some really great feedback from some really brilliant people, including Karen Alpert, who we've spoke with many times about this. So we basically wanted to do a follow-up to talk about that feedback and give some answers to questions we got.
Yeah, so previously we talked about that there is someone who claims to be an attorney who's claiming that you could treat, it's really easy to treat Australian superannuation as Social Security, therefore avoid punitive penalty. It's very simple. There's no tax due. His arguments really weren't all that great. We've found them lacking, and it's also, he claimed to have the special sauce that no one else did. There was a special thing he did that, if you just paid him, you'd find out. We really couldn't figure it out, and we also know from experience that there's no one at the IRS who actually reviews things that we know of that would ever agree with his position at all, and so we're sort of warning people about that it's very easy to claim that the IRS has taken a position when you file things because there's no human eyes actually looking at it. Try that in an audit where you have a revenue agent looking at what you're doing, and there's a very different standard of review when it's a machine reviewing it as opposed to a trained examiner who's looking for these issues. Now this is what I would also say, that we hope to be wrong. Well, we've let off the last one hoping to be wrong, and we're not saying that you can't win a tax court decision by trying to claim Australian superannuation is like the Social Security, therefore it isn't taxable, therefore the treaty saves it. We're not saying that. What we're saying is that you have a very big uphill battle because there's a lot of nasty things that sort of stare you in the face, and that's going to be a tax court judge that you would have to convince, or a district court judge if you file a claim for refund, that you would have to convince. So not saying they won't go for it, but they would have a hard time going for it as well. Robert, what do you think? What did Karen Alpert have to say, and what do you have to say about that?
Well, there were a few things that she brought up. One is probably the best one, I think, overall that gives you pause really from our position. It is the one where she's referencing some part of what looks to be some type of Australian law about how the payments and the contributions are made into the superannuation funds. This is not an unexpected argument, but one that has to be addressed. So the analysis that we were talking about was, last time, was that you're making a contribution, 9.5%, and your employer's making a contribution into your particular fund. It's got your name on it, it's got an account number, it's with a bank of some variety. I think there's several hundred different types, different providers you can have in Australia. And then we're saying employer contribution, our contribution, government is not involved. When you look deeper into the Australian statutes, though, it seems to be that there is an option, that might even be a default option, that says that you make your contribution as the employee and the employer pays a tax of an equal percentage, 9.5%, whatever happens to be. That makes it sound more like, well, I'm not putting the money into the account myself, and my employer's not doing that. We're paying Australia, and then Australia is putting that money into my superannuation fund. There's like an extra step to it.
Yep.
So she's saying it's like a Social Security tax, and she also did underline that you don't have to, an employee doesn't have to contribute anything to a super. It's really, they could just go with the 9.5% of the employer and you're fine. There's actually no requirement. And there is sort of, and this is the problem, is that that we're U.S. tax experts and we're pretty good with U.S. products. And now, the tax code with worldwide tax jurisdiction has to make us an expert on Australian superannuation too. Yep. And that's really sort of the unfairness of all this for not just taxpayers, but the tax professionals, where we're trying to step into the minds of, well, how does Australia think of this? And I think that's some of the other arguments too, to say, well, because the argument was asked, this was a question asked to me, someone asked it on Twitter, I think, well, what if Australia came out with a declaration, the proper authorities that said superannuation is Social Security, period. What happens then?
To use one of my favorite terms I've used, I learned in law school, I would say that's probative but not dispositive, meaning you would look at that and go, okay, fine, that's a legitimate, a serious piece of evidence.
Some sexy lawyer talk right there, Robert. Very. Is that how you picked up chicks at parties?
Anthony hired me for a reason. So that would cut against our argument saying that it's not social security, because now Australia just says, but it is. And it's important to a certain degree what the local jurisdiction, what Australia says to a certain degree. But what's most important, especially from the IRS's point of view, is not so much what Australia says, but how a U.S. court would interpret this matter. And a court might look at what the local law jurisdiction would say, but they might still look at that only as like I said, a bit of evidence in favor, but not a winner by itself.
And this is where I say that you go and you say these things, you say these absolutes, and that's why I won't say an absolute that no U.S. tax court, no U.S. court at all would ever find that Australian superannuations are Social Security. I won't say that because there's the Eshel case was a district court case, or I think it was in tax court, and it got up to the Circuit of Appeals, and there the court said, we want to know if France considers this tax a Social Security tax. So go off to France and get the answer. And of course, the answer in France is like, we don't know either. So it's sort of a back and forth.
What does America
think? So the fact that if Australia did say yes, it's Social Security, that's a great fact. That's awesome, and that could increase the chances of a victory. It's still uphill. I wouldn't say it's going to be dispositive on this at all.
It's a good word.
Mm-hmm.
I heard it once before.
Yes.
Yeah.
Yeah. So the court would have to. So the IRS is going to look at it and say, okay, what's a court in the United States going to think about this? When you go up to, for example, for appeals, who are looking at risks of litigation on any tax matter, they're going to look at this and say, what's a tax court going to think about this, or maybe even considering what other type of circuit court might think about this particular matter.
Mm-hmm.
A lot of stuff in America we kind of have as kind of like a background in our mind about and how things are supposed to be, such as, oh yeah, my 401k is, that grows, but that's not taxed to me because it's my retirement account. And we say that almost like it's a truism, almost as in the thing itself just has that property, but that's not true. There's specific Internal Revenue Code sections that say this particular type of account does not have the income flow through to the holder in the United States until distribution.
Now, is this where Breaker Tax Law got the, what do you call it?
The FOIA.
Yes, the
FOIA
FOIA
he got the
request.
FOIA, yep.
And it seemed like from the FOIA request that nobody in the IRS that we could see knew anything about this. It was just a series of people forwarding the same question to people after people after people after people in the IRS, everybody was like,
the first response. I think it was basically the first response in the Freedom of Information Act request was sort of the best response. Here's our official position. Here's our unofficial position on how our treatment is. And then there was an email chain of trying to see if anyone would disagree or agree with it. And I think most people were trying to run away from it because no one really wants to stick their neck out on this.
So there's no actual Internal Revenue Code about superannuations?
There is absolutely none, and there's nothing in the Internal Revenue Manual. You're not going to find any regulations on it. And I think that's it's sort of nutty. You have something that's so consequential. I think, 400,000 U.S. persons are in Australia, something like that. It's a decent amount.
Wow.
And Australians in the U.S. too, because if you're in Australia, you come to the U.S., you probably still have your super back home. Mm-hmm. So about 400,000 people this is affecting, and yet we still can't even get clarity on this. And that's really what's obnoxious, that that you always are relying on, some attorneys' position of, okay, this is how we're going to treat it, that you yourself, it's pretty impossible to come up with your own answer. And then you'll also see disagreement. That's really our point, is Karen Alpert, very smart woman. She's got her opinion on it, and we're going to disagree with some of the things that she's bringing up with. And she's trying to get that, the treaty that's not so well written, fixed. So she's not just, she's something much more than a layperson. And it's very, very difficult for the average person, and it's difficult for the above average person. to figure out. And it's sort of bigger than the IRS to figure out.
So quickly tell me, just because I'm spacing a little here, consequences for not treating your Australian superannuation correctly. Is it FBARs? Is it penalty? Like what's going to happen?
Well, I don't think there's anyone out there. There's nobody out there who's saying you shouldn't put it on your FBAR.
Right.
Everybody agrees you should put it on your FBAR because that's just an easy thing.
Okay.
That's an easy fix. Put it on your FBAR. You don't have to worry about penalties. Okay. Some people will say put it on your 8938. There's no real problem with that.
Okay.
Now, this is where you get into the risky area. If you're going to claim now, by the way, if it's an issue where you have made less contributions than your employer, you have a very simple issue. Just maybe I should have left off with that. You have a very simple issue. What we're talking about is where you've put more into your superannuation than yourself, or you have a self-managed superannuation. Right. Those are the two situations we're talking about. If you have one where you really didn't put in much or less than your employer, you have a very simple case. We're just talking about FBARs and 8938s, and there's really no dispute over that, except that some people want you to go above and beyond. That's what.
Well, one other thing I think we were asked to talk about was, well, you know, in Australia it seems it's a little bit more. It's not as obvious that this would count as an employee's trust. I've heard some different people say that. I will disagree without getting into great detail on it of what they were saying, but I mean, at the end of the day, this is your employer putting money into an account, whether or not it's a tax or a direct contribution into a retirement account in your name that has some type of trust aspect of it. Keep in mind that we're talking about forms that might need to be filed for foreign trusts. It just so happens that a pension is a form of a trust, like the square and rectangle thing. Square is a rectangle, but a rectangle is not a square. So these are, we think that these, I think, are much more obviously employees' trusts, and therefore you get a whole lot easier tax treatment. And it's like Anthony was saying, the ones that really have the issue that you really got to be careful about are your self-managed and ones where you put more money in than the employer.
Right. So, because the risk of getting it wrong is that you'll have at least one form to file, a 3520A, and some years you may have a 3520 as well.
Both.
Or both. Okay,
you have to have both.
You'll have both. Okay, so each one of those forms is a $10,000 penalty for not filing.
Right.
Then you say, okay, well, maybe I'll just file a 3520 and I just won't put anything on it, then I can avoid the penalty. Well, no, the IRS doesn't take that. If they believe a form is substantially incomplete, they'll penalize you too anyway. And the problem is that if you go for this treatment, if you try to sneak this through, and the IRS is like, well, we've had our, they'll get their panties all in a bunch because you went against their unofficial official policy that is very hard to, like, well, you should have known. They impute this level of knowledge to people. You and I were talking about this morning. That's pretty crazy that that for a reasonable cause penalty abatement standard, it's like this, that yes, you can rely on an expert who's really good in their field. However, you have the ability to be able to determine who the expert is.
Right.
Which is sort of impossible. That's why you hire an expert to begin with. So I guess you have to hire an expert to let you know if your expert's any good, but then the expert you hired to see if that person was any good, how do you know they're good, right? So it never ends. And that's where it's like it's this crazy standard that the IRS throws on people. And we've seen we've had better luck reducing FBAR penalties than reasonable cause penalties on these forms because the IRS just automatically assesses them, and they have this really huge standard that they look to see, okay, does this person have reasonable cause? And the fact that the IRS doesn't have a stated public position on this, right? They don't, is not reason for reasonable cause. I mean, that seems unreasonable. That's what it is. Now, we also had something by, someone else wrote in something, John Richardson. He also wrote something in.
I think we saw something that was something that was referenced in that email. By Karen Alpert, treaty interpretation and the expectations of both parties to the treaty need to be taken into consideration. So
that's a plus.
It's a plus.
It's a plus.
It's a
okay,
plus.
Good.
And there's a recent court decision that came out that I believe the judge said to the IRS, like, look, you got to tell me what the other side thought was going to go into this. You can't just give me your pure interpretation of the entire thing. You have to give me some evidence as to the other side. That's what their intentions were. The meetings of the mind. We're making a contract here between sovereigns. I need a meeting of two minds. We got to know what each were thinking at the time. And even with that, I think just from the text itself of the treaty that you and I reviewed, I've reviewed it with some of the other attorneys here, even if we had to look into the state of mind from whoever negotiated this for Australia, on the face of it, it doesn't look like they were thinking that this was going to be an issue, and didn't think on its face that we needed to make this explicit or that we were going to be doing this. In the code section, in the treaty section that's been referenced in the previous article that we've been talking about, and some of the other things we've been talking about, it basically says Social Security or other public pensions paid by a contracting state. That's the opening phrase of that. Social Security is capitalizing that. In my mind, that reads like a proper noun. So they're referring to our Social Security. And then it says, or other public pensions. I don't think that if you consider these 500 different entities in Australia that might be paying you out for your retirement in 20, 30, 40, 50 years, even if you consider them possible agents, at the end of the day, your check is coming from a bank. It's not coming from the state of Australia when it's coming out of a superannuation fund. So on its face, it looks like the intentions of the parties were pretty clear. Because, like we mentioned last time, in Australia there is a public pension. There is a Social Security option. It's just means tested. So if you come out at 65 and you've got $1 million in your superannuation fund, the Australian government says, look, I'm sorry, you don't qualify for this, but hey, congratulations, you got $1 million, US or Aussie, whichever one you choose, to be living off of. And if anything is a problem, obviously, I'm sure there's some way that you can go back and try to get that old age pension again. So if you read it on its face, it looks like, well, it doesn't look like they're talking about this specific. It's never mentioned by name. We'll mention Social Security by name all throughout the thing, but it's never mentioned by name. And everything that we're trying to do to get the superannuation funds part of the treaty, we're really trying to torture the language here to me.
You're trying to make it, I guess you would have to call it a public pension.
You have to call it a public pension.
That's probably the stronger. You can't. I don't think it's worth trying to go for calling it Social Security.
No.
Going for a public pension is probably the best possible argument. That's how I would go if this was going to go to tax court, because then I would mention what Karen says, what Karen Alpert mentions. Like, well, it's a tax on the employer that can go through the intermediary of the state. It may go direct, but either way, that is probably your best bet. But my point is, the reason why we tend to, we explain the risks to our clients. No one really goes up and takes us up on the offer to say, okay, you want to challenge it? Okay, this is what we're looking at. If we're wrong, the IRS can go back all these years. There's no statute. If you don't file the 3520, 3520A, the IRS can go back all these years, and it's a reasonable cause standard that is kind of hard, and they can assess you that $20,000, and by the time your tax court decision is heard right now, you can have 8 years of that, so you're looking at $160,000 of penalties if you're wrong, along with any taxes that you might owe too. So this is why, unfortunately, the IRS, sets this up too to, divide and conquer. Everybody alone, it's not worth it to fight. But if people were together to fight, then the IRS could be knocked down. But the way it is now, everyone's looking at, well, I can't have my fortune destroyed by this if it goes wrong, which is the reality of it. And that's how our hands are somewhat tied. We don't want to go taking a risk to prove a point.
Right. And I think some people have been like, why are you guys being so anal retentive about this? Like, what's the big deal? The IRS isn't auditing these. But there was a time where they didn't audit offshore disclosures until they realized, wow, we can make a bunch of money off offshore disclosures.
Well, I think
they
that's
didn't
the
audit
thing.
FBARs.
Right.
For a while, the IRS was saying, oh, we're going to audit streamlined submissions. And everybody was like, well, they're not doing it. And now they've started doing it. So I think there's somebody at the IRS that's going to go, guys, we can get a ton of money from these penalties. So let's go after these people and take advantage of the fact that it's really unclear. And how many people are actually going to fight us because we're the IRS.
And that's what we've seen. For a while there, we would have people we were getting through the program. We'd opt out. The IRS can now go and assess them. 5471 penalties, which are like your 3520A penalties, 3520. And they're just like, oh no, we're just not assessing those now. They could. They just decided, no, we're not. We just don't feel like it now. Okay, that's great, but they changed. Not everybody, but. Yeah, and that's the thing. You don't know who changed and where this is lurking. So it's just incredibly dangerous. And let me tell you, those penalties happen, and they're very real. The IRS is very convinced.
Add up.
Yeah,
They add up real fast.
And the IRS is convinced that they're going to collect them. They're going to do whatever they can. Now, if it's in Australia, they got a problem there. But if there is something attached in the U.S., and also they could take your, the passport, right? So if they whack you with this, $160,000 of penalty, it counts as a Title 26 debt. That is what they could take your passport for because it's over $50,000. So now you have a problem. So now, you're going to have to give up you're giving up your U.S. citizenship. You're going to have to rely on a different passport. So that's really the pressure that they have now. And that's why usually when we talk to someone with a grantor trust, like, look, this is a lot of accounting work to do, a lot of tax prep work to do, and it's going to take a little bit of time to get this done. Okay, what are my options? Well, your options are this. Okay, what are the risks of that? Ruinous penalties.
Yeah.
And it's not, again, let's just cut out FBAR. Assume that we have the FBARs properly filed for all the year, for all the years in the statute.
Yep.
We're just talking straight 3520, 3520A penalties.
All right. So we'll take more feedback?
Yes. Oh,
Yes,
yeah.
okay.
Yeah, right. Yeah, more.
We could do a third video.
Sure, absolutely.
Yep. All right. So if you have any questions or comments, don't hesitate to comment below. You can subscribe to our channel so you get updates about superannuation and other awesome tax issues. You can reach out to us, info@irsmedic.com or 888-727-8796. Thank you so much for watching.
That was very dispositive.